Hello listeners, my name is Charles Scott. The program in which you're about to listen to is called Can We Talk? I'm here with Charles Scott Jr.
How are you guys doing
my
today?
son, and we hopefully are going to give you some information that will help you not only with real estate, as you know we're real estate brokers, but also with your life and some of the things that are happening locally, nationally, and globally. A lot of things are happening. As I said, in the last 6 months, there's so many things that are happening. Every week we turn around, there's something that you wouldn't think is happening all over again. I mean, we've got high gas prices, we got the war going on. You know, we thought the war would be over in 3 weeks.
Right?
How long's that been going on now?
Almost 2 months now. We're approaching May.
Seems like longer than that.
It does seem longer, doesn't it?
Seems like it's forever, you know? And it's like there's no end in sight. You know, I feel so sorry for those people that are over there. And if do yourself a favor, if you go onto YouTube and look up the city of Kyiv.
Yes, Kyiv.
What is it called? Kyiv, right?
Yes.
Look at what it looked like 6 months ago. That was the most beautiful city in the world. I mean, not a piece of paper on the street. The people were festive.
Tourists,
flowers, programs.
Not a care in the world.
Not
people
a care in
laughing,
the world.
playing.
I mean, that was a beautiful city. Who would ever think that here we are 3 months later and everything is just totally upside down.
Upside down.
Rubble, upside down, a lot of death, destruction. People have nowhere to go. It's, you know, it just goes to show that you have to be careful of your blessings and appreciate what you're doing, because at a minute, everything could be turned upside down.
Take nothing for granted.
So you take nothing for granted, and you prepare for the future, and that can be anywhere. Anywhere democracy is at stake. So, you know, we're here to sort of give you an idea of some of the things that may be occurring within the United States or globally, as far as what's happening. Even the supply chain, look at what's happening. We thought this would be over with by now.
No, it's still extending. You see people in Los Angeles, the ports are still full. They're taking what they can, but you know, that affects the entire United States.
That's right. You know, gas prices are still up. And they're doing everything they can to lower the gas prices. They've released the gas from the reserves.
Yep.
They've
got the gas tax holiday, they call it in Connecticut.
Connecticut, they've done a gas tax holiday. They reduced the price of the taxes on the gas.
Buses are free. Buses
are free.
You can take a bus anywhere you want right now.
Take a bus anywhere you want.
To some, that could be an advantage, you know?
That's right. You get on the bus, it doesn't cost you anything. And then I noticed the last thing, just last week, the government is ordering lower octane to be used.
Oh, okay, yes.
So that basically, if you require a higher octane in your car, they're adding additives into the gas so that your car can still run, but not have to cost you as much for the gasoline.
Yes, they're doing whatever they can do to basically lower the cost.
Whatever they can do to lower the cost of everything, so that people can, you know, have some type of alleviate their concerns. And
where are we seeing high costs? Real estate. Right now, house prices are still increasing because, as you see, interest rates are approaching 5%. Actually, I believe the short article did hit 5%.
I think it's over 5%.
Yeah, over 5 now.
You know, we were at just over. In November, we were at around 3%.
Around 3, yes.
At around 3%. At 3%, now it went from 3 to 4 to 4.5. Now it's 5. And they're saying that we're going to have at least maybe 3 or 4 rate increases.
Now you see how fast it went from 4 to 5 versus 3 to 4. 4 to 5 was really quick. That was like less than a month. So we're going to see possibly approaches 6 and 7 even quicker as they put these rate hikes throughout the summer.
And you're going to see things go up rapidly. So I have to encourage everybody out there that when the prices change, they don't change slowly. It all happens drastically.
Yes.
And things start going up. So what's that mean to you? If you're out there and you're looking to purchase a property, and let's say you qualify for $300,000 and the interest rate was 300%. Now let's say the interest rate is 5%. Well, you
Yes.
no longer qualify for
No.
300,000. You might qualify for 200,000.
200. And at that point, you're unfortunately, priced out in certain markets. Certain cities, they call the entry point is 300,000. You're qualified for 200. You have to find a new location that you can actually get a property for that price.
And not only that, you have to look at this. What we find is that there's a low inventory on properties because people that are looking to sell their homes, now they're in a bind because if they sell their home, now where do they move to?
Exactly. They don't want to go back to renting. They're comfortable. They've been a homeowner for the last 20 years. But the thing is, we see that a lot, contingent upon finding a house. You can't buy the house until the current homeowners have located their new house.
That's right. So what happens is that you have a lot of people that are in a bind and they are stuck trying to find another house from the house that they sell. And now what happens is the new house costs more than the old house that they were looking to sell. So it puts them in a bind and it puts the buyers in a bind. So everybody ends up having to try and figure out what they're going to do.
Exactly.
And then what happens is that when the prices go up, the interest rates go up, the prices go up, and then you have to make more money in order to qualify for the bigger house. And based upon the interest rates, you have to make more money, and then on top of that, there's the thing called the PMI, that's that insurance that you have to buy against the house. That increases, so everything's like a boomerang effect. So another thing I want to warn everybody about out there, maybe some people have been sitting on the guidelines, and maybe you got pre-approved maybe 4 months ago, 5 months ago, and you're still walking around with that piece of paper in your pocket. And that piece of paper in your pocket says that you qualify for $300,000. But make sure you check on that piece of paper what the interest rate was when you pre-qualified.
Exactly.
That's right.
Different interest rate. Also, those pieces of paper have expiration dates. Some people, they say, I'm pre-approved, I can buy a house, I can actually take my time. You can take your time in the beginning, but you look at the bottom of that paper, it does say you have 3 to 4 months to, you're locked in at that rate.
3 to 4 months. So yes, you can still buy a house. But if they locked you in at an interest rate of, let's say, 3.1, and now the interest rate is 5%, and they were able to give you a mortgage for $300,000, now with that new interest rate, no longer can they give you a mortgage for $300,000. It might be $200,000.
Exactly.
So now what happens is when you go out there and you're looking for a house, you've got to call your mortgage person up and say, hey, what am I qualified now with this new interest rate? And they're going to say, well, based upon the new interest rate, here's the amount that you're qualified for. So you can't use that old pre-qualification. You have to upgrade.
And the thing is, that puts some people at disadvantage because when you have this interest rate, they lock in for 3 to 4 months, some of these closings are going to take longer. Like we said before, the current homeowners have to find a house for themselves. So you may say, oh, wow, my closing date's after where my pre-approval expires,
That's right. So you've got to check everything constantly now. You've got to keep in touch with your mortgage company. Also, I'm constantly reminded, people are always talking about, well, what type of programs do you have for first-time home buyers?
Oh, yeah, we get that call daily, right?
All the time.
All the time.
So suppose you were buying a house and you qualified for a first-time home buyer program 4 months ago, and the money for that program has run out.
Yes.
So now you no longer qualify for that money. So now that means you have to put down your own money.
Yes.
There is no down payment assistance money. And so now you're totally priced out of the market because you waited too long to go out there and look for that house.
Yes.
So it's a matter of a lot of changes that are occurring. You got to keep in touch with everyone. You've got to see what the market is doing, what the interest rates are doing, what areas are increasing in value. What we're doing now, we talked about it today, is that when people are looking for a house, we're actually telling them, before you go and set up all these appointments to go see homes, check what the price of the homes are today, not what they were 6 months ago. Check and see what the rates are today versus 6 months ago, because what happens is some of those prices have gone up. And check what your interest rate is and see what you qualify for. You may not qualify for that new home that you had qualified for before.
Exactly. And we also want them to also check to see what the monthly payment is. I mean,
Oh,
some people,
that's important.
they get qualified for $350,000, $400,000. They feel really proud. You know, maybe they'll be the first homeowner in their family. And they say, well, I can buy a house for $400,000. And then when they see a house for $400,000, we tell them, go back to your loan officer and tell them to calculate the payments, the principal and the interest. And they'll say, wow, I'm going to be paying $2,900 a month. I don't want to pay that, Mr. Scott. We get that a lot.
That's right. So I always tell everybody, well, look, just because the bank told you qualified for a $350,000 mortgage, when you figure out how much your monthly payment is going to be, is that how much money you want to spend on a monthly payment? And sometimes they say, oh, no, that's too much. Well, you can't have your cake and eat it. You can't have the price going up, the interest rate going up, and the amount of the mortgage stay the same.
Nope.
Everything changes. So what you have to do is calculate, what is my new payment going to be? And you know what? It doesn't really take a lot to figure that out. I tell a lot of people, well, go online and look up what they call a mortgage calculator.
Yes, they have apps also.
There's got all kinds of apps out there. Go online and put inside there, it'll ask you the question, how much is the house selling for? How much are you making an offer for? Then it will ask you, how much are you putting down? And then it will say, how much is your balance going to be? And then you have to figure out three other things. What is your insurance going to cost? How do you figure that out? Call your insurance company and ask them.
There you go.
Hey, I'm thinking about buying this house. It's $350,000, and it's got 4 bedrooms, and it's got 3,000 square feet. And here's the address. How much is the insurance going to cost on that house? So then they tell you what the cost of the insurance is going to be. Then you say to them, okay, I need what they call that PMI insurance. What's that? That's an insurance that you have to put on the house in case you get foreclosed on.
Yes.
So now you got to add that into your mortgage payment. So now you've got your insurance, you got your PMI, you got your principal and interest, and then you take the taxes on that house and divide it by 12. So if the taxes are, let's say, $6,000 a year, divided by 12 months, hey, your taxes are $500 a month. When you add up all those figures, there's your mortgage payment.
There you go, right? And if you have all that written down, you can actually ask Alexa if you put it in that order. Alexa, we tried it. She'll figure it out.
We tried it, right?
Yes, very true.
We said, Alexa, how much is the mortgage payment going to be if we have a house of $300,000, if we're putting down $20,000, and if the mortgage rate is going to be 5%, and the payments, how much are the payments going to be? And Alexa came right back and said, this is what your monthly mortgage payment's going to be. So it doesn't have to be, have a rocket science. Alexa, the app, can tell you how much your payment is going to be. Because all they need to know is your payment amount, how long the mortgage is going to be, the interest rate, and the insurance rate.
Exactly.
And and all banks use the same principle.
The same. Some people think certain banks have certain types of mortgage, or they're using basically a calculation.
That's it.
That's it. It's the same money. It's still the green money in every bank. It's just a matter of where you're going, and as far as where you get a loan officer from.
That's it. The only difference is in some banks the interest rates are slightly different.
Yes.
But the interest rate is not going to really make that much of a difference when you figure out the whole equation. If the interest rate is 4% with one bank and 4.5% with the other bank, then your payment is only going to be varied by about maybe $50 a month.
Yeah, that's about it. Definitely.
And then you've also got to realize if the interest rate is less, the bank charges you more for points. That means they charge you more money to do the loan.
Exactly.
When you figure it all out, it basically comes right out to the same amount. And so this is how you've got to figure it out.
And we tell you this just because, as you can see, in this internet age we have, there's a lot of applications and websites that people can use in their own independent time to figure out where they stand in their mortgage, their home buying process. Are they ready? They may not be ready. They might want to stand out for a while, but that's why we're here to help, the public.
Right, and I'm finding out that increasingly, these are things that we have to educate you, the public, into knowing, because it's unreal. A lot of people go out, they look for a house, and they don't have a clue as to how the payments are figured out or how the payments are calculated. And it's very simple. They just figure 4 different things, and there's the cost of your mortgage, right there. It's not something that's, rocket scientists, and the bank figures out that mortgage payment for you. And then what you do is they put all of those figures together, and then you know ahead of time what your mortgage payment is going to be. The only difference sometimes are the programs. And how does that work? Well, some programs require that you put more money down.
Yes.
So if you're putting down 20% down versus 3.5% down, then what's going to happen is that your mortgage payment may vary by as much as maybe $40 to $50 a month.
Correct.
But it's not going to be a tremendous amount of difference just because you're putting a lot of money down. The more than anything, what's affecting it is the interest rate.
Yes. That's why you see on the news, interest rates affect anything from your car loans to your credit cards, but especially real estate.
Interest rates control everything, so that when the interest rate kicks in, that's what's going to make a big difference on your mortgage payment. And that's why what's happening now is that people are rushing to get out there and try and buy a home.
Yes.
Based upon what the interest rate is going to be, and they're trying to lock in that rate. What's that mean, lock in the rate? So, okay, you go to find a house, and the bank says, okay, your interest rate is going to be 4%. And if you pay us another $1,000, that interest rate will stay at 4% for the next, let's say, 4 months. So now, no matter how high things go, we won't charge you no more than 4%. So that's the way of locking in that interest rate. If you don't do that, then there's another thing called float.
Yes.
That means that they're going to charge you whatever the interest rate is at the time that you do that loan. So if it goes up, then guess what? When you close, the interest rate is going to be more.
Very true.
So you have to be very aware of all of these things when you're looking to purchase a home. Everything out there is based upon the interest rates, the amount of the down payment. Now, if you are looking to purchase a mortgage, there's mainly 2 different types of mortgages out there, and that's the FHA and the conventional. Now, if you're doing an FHA mortgage, the FHA mortgage will let you go as little as 3% down.
Isn't that amazing? People don't realize, some people think you have to have a lot of money saved up to buy a house. I mean, it's recommended you should, but for FHA mortgage, you 3.5 down.
That's right. You don't have to have 20%, 30% down. You can buy a house with as little as 3.5% down. Now, just remember, nothing is free.
No.
So at 3.5%, that means that basically you don't have to have a lot of money down to buy the house. Your mortgage payment is going to be slightly more because you're only putting down 3.5% down, and your mortgage payment will be locked in. It's still going to be locked in over a 30-year period of time. So you're better off if you can get a locked-in rate at 3.5%. And one of the advantages of an FHA loan is that you don't have to have as much money down, and they will allow you higher ratios. What's that mean? That means that you don't have to have a huge income in order to qualify for the loan. With an FHA loan, you could have a ratio up to, like, let's say 53%. So they'll allow you to buy a house up to 53% of whatever the mortgage payment is. 53% of the mortgage payment can be based upon what the value of the house is. Now, when you do a conventional loan, you have to put more money down, but they won't allow you 53, they'll allow you like 46%.
Correct.
So you got to realize there's a little bit of a put and take with all your different mortgage programs. Both programs are good programs. But my advice, and I'm sure your advice, is save as much money as you can.
Exactly, because tell me the advantage with the conventional. If you put 20% down, you don't need the insurance that you need with the FHA.
That's right. Right. Because if you're putting down the minimum amount, you're still going to need that FHA insurance, and that gets added onto your mortgage payment.
Exactly.
So if you're doing a conventional mortgage, number one, you don't have to put down as much, and then on top of that, there's less restrictions, less requirements. With an FHA loan, the bank will give you more of a leeway as far as the condition of the property. It doesn't have to be like in perfect shape. There could be a little chip paint. There could be a little sidewalks need a little repair. The roof may need a little repair. The inside of the house could need a little paint.
So they call those handyman specials in our industry.
Well, some handyman specials, but not too much of a handyman special, because
you want to be falling apart when you get there.
You still got to be in livable condition.
Exactly.
You still got to be in livable condition, but the thing about it is that they will give you a leeway to be able to purchase that property without you having to go in there and totally remodel that property. Now, actually, to be honest with you, that's a good deal.
Sounds like a great deal.
I bought 3 properties that were FHA. The reason why is because I got a super deal on the property. They didn't need a lot of work to begin with. I was able to put down a small amount of money, and for the repairs that it needed, I was able to go FHA without putting down a tremendous amount and be able to finance it over a longer period of time. Then I'm able to go in there, fix the house up, and then refinance the house to a conventional mortgage. Go in there and then fix the house up, and then reduce my mortgage payment and do a conventional mortgage. And now I've got a really nice house, a low interest rate, and the value goes up. So
and
now
with
that's
that money you pull out, you can invest in another property.
That's right.
That's what the next step is.
Right. You got it. So now I've got extra money from that investment that I can take and put into another property. And then what do? You got equity.
Got equity. And some people say, wait a minute, why not just do another FHA loan? You only can have one FHA loan at a time. That's one of the rules that's in there.
Right. The FHA loan is basically for a person who's looking to buy a house that doesn't have all of the money to put down. So the FHA program is so that they are assisting you to be able to purchase that property without you putting a whole lot of money down. And so now you can buy another property, and then you don't have to put all that money down. And then you could turn around, and later on, you can move into the property, you can move out of the property, you can rent the property.
There you go.
There you go. Now that's what they call a triple burr.
Yep.
that's a home run.
Exactly.
Where you now buy the property, fix the property up, refinance the property, and then put a mortgage on the property, and then you turn around and refinance the property, and then you let that property pay for the other property.
Exactly.
So now you're able to add to your retirement. So that's how you do it. I have created many people with wealth.
Yes.
How many people have we created?
That's one of the greatest things we see in our industry, because we have customers from a decade ago. If anybody remembers, a decade ago, we were just coming out of a recession, 2008, 9, 10, and we have customers even then that will buy houses. Man, houses were cheap back then, weren't they? Oh man, 2009, 2010, 11, and now these same customers, they're coming back to us now, 2022. They have a lot of equity, life-changing equity, they're telling us.
That's right. They have a lot of equity in the property. and they're able to buy another property and keep the other property. It's not like they got to sell the property. They can keep the property, and the rents have skyrocketed. So the rent that was actually being charged might have been $1,200. Now the rent they're charging is $1,800 a month.
Yes.
And their mortgage payment might be $1,300, $1,200. And they're getting $1,800 a month in rent. So they're not only keeping the other property, they got a lot of equity. They're refinancing the house. As the property value goes up, then they're in good shape.
They have cash flow.
They can send their children to school.
Yes.
They can start a business, and they can pay off that house and still have equity. So that's how you build wealth in the long run. So.
Exactly.
That's what we do. We try and sit you down, show you how to build up your wealth, how to build up your equity, and give you an idea as to what you can do.
And like we tell everyone, it takes steps, you know. It may not be overnight riches, but it's a proper way to go. And the American dream is real estate. It's one of the best ways, best avenues in order to gain wealth.
That's right. As long as it's structured right and you take your time. Don't be, no rush into it.
Don't rush into it.
Take your time, calculate what you're doing, read up on what you're doing, and do it methodically, a little bit at a time. Google different situations, and learn what you're doing.
And surround yourself with experts, people people that have actually gone through the same process.
Realtor, lawyers. Everybody's got to be a professional.
Yes.
Don't go taking the advice of people on the street that don't even own a house.
Oh, we get that a lot, don't we?
They don't even own a house.
But Mr. Scott, well, that
my
person
friend
that told you
me
that.
this. My friend told me that. Do they own a house? Nope. I'm like, well, so how are they telling you all this advice and they don't even own a house?
Exactly.
So, again, I'm going to close, but time goes by so fast.
It does, doesn't it? Let's hope we come back next week and we'll have even more information for you.
Yes, we're going to be closing down soon. As I said, we give you a lot of information, and we're going to turn it over to Eldridge Gloria Brown. And she's going to be giving you a wealth of information for the spiritual and for your mind. And to get, you need two types of information: financial information and spiritual information.
Yes, those have to be
if your mind is not right for it and you're not ready for it, then no matter what you do, someone out there will turn around and bring you by the wayside.
That's
so
what they say, don't they?
you gotta be prepared, okay? So until next week, God bless. Shalom.
Yes.